Telecom Plus shares crashed 31% on Tuesday to 663 pence, their lowest level since 2012, after the company reported its best-ever annual results. Adjusted pre-tax profit rose 4.7% to £132.2 million for the year to March 2026. Revenue advanced 5.6% to £1.94 billion. Customer numbers grew 23% to 1.43 million. Every metric improved, and the stock collapsed. The reason sits not in the results themselves, but in the disclosure published alongside them. Telecom Plus unveiled a 5-year investment plan that requires spending roughly £55 million per year in additional costs, starting now. The bottleneck is the near-term earnings consequence. Management guided adjusted pre-tax profit for FY27 to £80 to £90 million, down 39% from the £132.2 million just reported. That is not a profit warning caused by a deteriorating business. It is a management team choosing to compress its own earnings in order to build a larger one. The dividend was cut 47% to 50 pence per share for FY26, with the balance shifted into a £40 million share buyback. At 663 pence, the shares sit at the bottom of a 12-month range that stretches from 710 pence to 2,025 pence. The market is not pricing a recovery, it is pricing doubt about whether the plan delivers.
The 5-year plan has 4 targets: double multi-service customers to over 1 million by FY31, build national brand awareness, expand the partner referral network, and strengthen digital infrastructure. The investment rationale rests on the difference between single-service and multi-service customers. A customer taking only one service, say energy, generates lower margins and churns more easily. A customer taking energy, broadband, mobile, and insurance through utility warehouse generates higher revenue per account, lower proportional cost to serve, and a meaningfully lower churn rate. Telecom Plus does not disclose the exact revenue differential, but the model is structurally identical to a telecommunications bundle. The economics of each additional service added to an existing customer relationship are considerably better than acquiring a new single-service customer. The plan targets adjusted pre-tax profit of £175 million by FY31 against the £132.2 million reported today. That is a 32% increase over 5 years, achieved by first destroying nearly 40% of current year earnings and then compounding back through a larger, stickier customer base. The buried assumption in the sell-off is that the market is treating the £55 million investment as recurring overhead rather than a front-loaded cost that buys durable customer relationships. If the multi-service customer mix improves as management intends, the cost per customer in FY31 should be materially lower than today's. The investment is a bet on unit economics, not a permanent cost uplift. What the articles do not provide is any quantified data on how multi-service customer lifetime value compares to single service, or what level of multi-service mix is required to close the gap between FY27's guided £85 million and FY31's targeted £175 million. That gap is the mechanism the plan has to prove.
Peel Hunt, the house broker, responded to today's disclosure by cutting its price target from 1,850 pence to 1,400 pence, a reduction of 24%. It also cut its FY27 profit forecast by 39% to £85 million. Then it retained its buy recommendation. The market sold the stock to 663 pence. Peel Hunt's revised target is 1,400 pence. Both responses are reading the same facts. The market's conclusion rests on near-term certainty. FY27 earnings are definitively lower, the dividend income is lower, and the proof of the FY31 thesis is 5 years away. A stock priced on a near-term earnings multiple adjusts downward when that earnings figure falls 39%. Peel Hunt's conclusion rests on the behavior of multi-service customer growth. Analyst Charles Hall noted that multi-service customer numbers have materially improved. Partner activity is accelerating at 15%, and the TalkTalk broadband acquisition has added a base of customers to cross-sell additional services into. His logic: if the early leading indicators are already moving in the right direction, the investment program is deploying into proven demand rather than hoped-for demand. The conflict is not about the FY27 number. Both sides agree it will be around £85 million. The conflict is about whether the FY31 number is achievable. That is not a disagreement about accounting. It is a disagreement about whether the partner referral distribution model can scale to 1 million multi-service customers. That assumption, that the referral model is scalable to more than double its current size without structural degradation in partner quality or customer acquisition cost, is the buried premise that neither the buy rating nor the sell-off has resolved. One side assumes it is true, the other assumes it is unproven.
The counter-argument to the buy case is straightforward. Churn rose slightly in FY26 to 14.2% from 13.7%. In a business whose thesis rests on sticky, long-tenure, multi-service customers, reducing per-unit costs over time, rising churn is a direct challenge to the FY31 model. Management attributed higher churn to the warm winter reducing energy consumption and household switching behavior. That explanation is plausible but not confirmed. It is the kind of attribution that looks credible if the FY27 churn figure normalizes, and less credible if it does not. This is the variable that resolves the hold versus exit dilemma, not the FY27 profit number. Both sides already expect that to fall. The discriminating metric is whether multi-service customer churn either stabilizes or falls as the investment program begins. Falling churn in multi-service customers would validate that the model is strengthening under investment. Rising churn would signal the opposite, that the cost of serving a larger, less self-selecting customer base is eroding the unit economics the plan depends on. There is no counter-evidence strong enough in the pool to dismiss the buy case. The leading indicators cited by Peel Hunt, accelerating partner activity, improving multi-service customer growth, are consistent with the plan's early-phase assumptions. The risk is unconfirmed, not disproven. The leaning is cautious. The plan is internally consistent, the FY26 operating model is demonstrated, and the house broker's read has early indicator support. But the entry point requires accepting that FY27 earnings of roughly £85 million are the trough, and that the churn figure will not continue drifting higher as the partner network doubles in size. For a holder, the monitoring variable is the FY27 churn rate for multi-service customers. If it stabilizes at or below FY26 levels, the trough thesis holds. For a watcher considering entry at 663 pence, the FY27 results are the first real test of whether the investment is buying stronger unit economics or simply masking a deteriorating retention profile. Neither group should act before that data is in hand. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.